I often get questions when I'm trading. I often get questions from people that talk about, are we live? Are we live? Mm, are we live? Okay, we are live. We are live. Fantastic. Sorry about that, guys. I had an intro prepared and then it takes ages to go live on this thing. Okay. Right, we're a minute in. Let's redo that. So, I often get questions where people ask me, "What leverage do you use? What type of what type of margin do you use? How do you use risk management, bro? What's an invalidation level?" So, I've been thinking about this over the last couple of weeks, and I've been wondering what the best way to do it is. Is the best way to have a recorded video, a 15 to 20-minute recorded video, a quick couple of bullet points around risk management, a quick couple of bullet points around position sizing, or should I do a live stream? I also thought about what the potential was of maybe going and doing a deep dive into the subject, the risk management subject. And I thought to myself, the best way to do this would be to give you guys a sort of bird's eye view on an interactive show. We'll do a video today which can be watched over and over again. We'll talk about the higher level points of risk management, the basic points. So today's video is going to be for a basic to intermediate trader, okay? Somebody who's preparing themselves to learn more about trading, somebody who's preparing themselves to, you know, dive deeper into the discipline that trading requires. All right. So today we're going to be talking about risk management, and like I said, it is an interactive show. So please feel free to leave your comments. Please feel free to like and subscribe to the channel. Whether you're watching this live or whether you're watching this in the future, I will see your comments. Don't worry about it. So if you're live today, then please leave your comments in the live chat. I'll try my best to answer them as best as I can. And if you're watching this on a later date or you're rewatching this, please feel free to leave a comment. I'll get around to it and I'll see it. All right, and we'll see what we can do. This is the first video that I'm doing or I've done, if you're watching this in the future, which will be focused more on education. Okay? So let's have a quick look at some of these comments. We've low turnout today. Very, very low turnout today. We have got who would have thought, right? Educational video, low turnout. We've got Elizabeth, always here. Love to see you. We've got AD. We've got Stanley. Great to see you, Stanley. Thank you very much for joining. We've got Joel, my brother, and then we've got who is this? Who's this that we've got here? We have got, I don't know, but I'm going to remove it just because it doesn't look. It looks like spam to me. Okay, cool. Well, thank you for those of you who have joined. We'll kick it off in just a second. I just want to wait for a few more people to join and then we'll kick it off. All right. And Cryptique, thank you very much for joining. Very much for joining, Cryptique. Thank you very much. And NR, looking forward to this one, brother. I'm looking forward to showing you guys. Yuri, welcome to the show. Appreciate you for joining. And what else have we got here? We have got fans of Satoshi. That's a new one. Great to see you. And we got Jay saying, "Hey, dude." All right. I'll tell you what we'll do. Let's kick it off. All right. Let's kick it off. So, risk management. What does it consist of? It consists of a lot of subjects. There's a lot to talk about when it comes to risk management. All right. It can get very, very complicated very, very quickly. But, I've taken a few bullet points that I think will help and add value to any sort of type of trader that you are. Whether you're new to trading and you've just joined, or whether you've been in trading for a couple of months, maybe a year or two, and you're looking to expand your knowledge, maybe look at it from a different perspective. Okay? So what I'm going to do is I'm going to share my screen. We're going to look at Bitcoin, or we're going to pick any chart, and we're going to start working on what risk management is. All right? So I'm going to share my screen now. There we go. Okie dokie. So this is a chart of Bitcoin. Let's go over to a chart where I've got nothing on there. Bybit FTX. Let's go Kraken. I don't think I've got anything on the Kraken chart. There we go. Oh, I do. I've got. Okay, right. Okay, got you. There we go. Right. So this is the chart for Bitcoin. Now, this is something that you're going to often see, isn't it? You're going to look at a chart, and the whole concept of looking at a chart is you're going to want to take a trade. And I understand that, So maybe, let's say, for instance, you're looking at Bitcoin here, you've done your patterns, you've done your support and resistance, and you've decided, I want to take a trade. For the sake of argument, today, we're going to be taking a short. Okay? This is not a live trade. This is not financial advice. This is an example. All right? Everything I'm going to be talking to you guys today about is examples. A big shout out to Trader SC, Trader XO, Crypto Cred, and Trader Dante. Those are the people that inspired me to do a video like this. Those are the guys that sort of taught me when I was sort of early into the game, 2017, 2018. That's where I learned this information from. Okay. And as I said, I'm not going to be going into too much detail, but just enough to evolve your trading as of today. All right. So, again, we're going to look at Bitcoin here, and for some reason, we've decided to take a short, right? Just for random argument's sake, we'll draw a line here, and we'll say, okay, I'd like to take a short on Bitcoin. So now, if we're going to take a short on Bitcoin, or if we're going to take a trade of any sort, right? What's the first thing that we need to look for? The first thing that we need to look for when using a risk management type mentality is your invalidation level. Okay? Take notes, your invalidation level, or more importantly, your stop loss. All right? Your stop loss is important because without a stop loss, you don't know where you're wrong on the trade. You see, when you're trading, the whole concept of it is you're picking a direction in price. You've identified technical analysis that enables you to make a decision on which direction price is going to go in. Now, if you have conviction and you've made a decision that price is going to go to, let's say, the downside, for instance, right? Then that's great, fine. You've done all your technical analysis and you've said price is going to go to the downside. What will it take for you to be wrong? What would it take for you to say, I think I'm wrong now? Price is going to actually go up instead of down. And that's where your invalidation level comes into play. That's where your stop loss comes into play. And that is the first most important part of risk management, your stop loss. And the reason I say that is because, again, I often see so many people focused on the leveraging side of things as opposed to stop losses, invalidations, risk positioning, position sizing. Okay? So in this particular example that I've got here, we're going to say, for argument's sake, our stop loss is going to be the highs that are here. So what does this high fall in as? This high falls in at 25,200 on the dot. Okay, so I've made a decision now that if price goes above 25,200, I'm wrong on the idea, and I think that price is going to go higher. Okay, I've taken a short here. If it goes above 25,200, I'm wrong on the idea. So let's plot that short out. Let's do that. Let's put this thing here like this. So for those of you who don't know what I just did there, on TradingView, if you go to this tab on the left here, and you go to here, right? There is long position and short position. I've clicked on short position, okay? And I've plotted it here. And I've used the mouse to move this up and down. And I've moved it just right up until 25,200. So that's what my short is going to look like. All right. Maybe we'll target here. This first real swing low, we'll target there. I don't want you to focus on the R. I just want you to focus on the short, and I want you to focus on stop loss. Now, even if price was to do that, the trade is invalid because I've been stopped out. Any price action over 25,200 and automatically I'm no longer in the trade. All right. I have to step back because I don't quite understand what the market is doing. Okay, perhaps I've taken an aggressive entry, perhaps I've done my technical analysis wrong, perhaps I'm just wrong in general. Okay, irrespective, the moment that price touches 25,200, I am out of the trade. Now, the next question is, and this is a question that I get often, is, well, hang on a second. If price goes to 25,200, then how much money am I going to lose if that happens? How much leverage should I go? How big should I go? Should I go 100x leverage? Should I go 500x leverage? Should I go 50x? Should I go 25x? Don't worry about that. The next question you have to ask yourself after making sure that you understand stop losses or invalidation levels is, how much money do you have and how much money are you willing to lose? So let's say, for example, I have an account size of $1,000 or £1,000. Okay, I'm going to use dollars because that's what I'm used to, even though I'm in the UK. Let's make that big. Let's make that bigger. There we go. Now, let's say, for instance, I have an account size of $1,000. All right, and I say to myself, okay, I've got $1,000 here. This is the trade that I want to take. I don't want to risk $1,000 because that's my entire account. I only want to risk maybe, let's say, in this particular instance, we'll say 10%. 10% is very high. It shouldn't really be more than 1 or 2%. Okay, but at $1,000, I understand. I really do understand. If you're risking 1 or 2%, you're not going to make the money that you want to make. You're not going to make any money that's substantial enough to really, really drive you to continue to trade. So in this example, we'll say we're going to risk 10%. Okay? And if we're going to risk 10%, if we're going to risk 10%, that means we're going to risk $100, right? Is everybody on board with me so far? I'm sure you guys are. Smart people in the chat. All right. Now, if I'm going to be risking $100, how do I make it so that if price here taps 25,200, I only lose $100? That is the tricky question. And that is what I find a lot of early traders or a lot of new traders aren't quite understanding when it comes to day trading, swing trading, any type of trading, anything that isn't hodling, any type of trading that involves leverage. I've noticed that people don't understand this very, very basic concept whereby if this is my entry here, my entry happens to fall in at 24,200, my stop loss is $1,000 at 25,200. How can I make it so that I'm only risking $100? That's the next question. Now, I wondered to myself, sort of, what is the best example to give you guys when doing this. So I found a UI here. This is an application called Simple Effects. I'm not being sponsored by them. I just didn't want to use any of the obvious ones, just for argument's sake. This is an account I used to use ages ago in 2017. This is a demo account. This is a demo account here. I highly advise, if you haven't got a demo account, that you guys should all look into getting a demo account and practicing something like this. You don't have to get the trade right. It's not about getting the trade right. It's about understanding how to position yourself, how to utilize your risk, and how to make sure that you're making it second nature. All right. And we're going to go into leverage in a moment. But now that we've got an application in front of us, we can actually take a potential trade with our parameters. So if I say, for example, I click on new order here, okay, no open positions, I click on new order, there are options that I see here, okay? So on this side, I see buy, and on this side, I see sell. These are the options that I've got. Below it, I see market and pending. So market, what does that mean? Market means that you are purchasing those shares at the current price, no matter what it is. Okay. As soon as you click on market, you're automatically entering the market at whatever price it is, and you have no issues. Okay. Pending means limit order. Okay, so on some applications, you'll see the word pending. On some applications, you'll see the word limits. On some of the applications, you'll see there's other words that people use, but essentially, pending means limit order. Limit order is what you'll find on most sort of apps. Okay, so now in this particular instance, I tend to use the pending. I don't like to use market. I like to use pending. When you use market, there are fees associated with the trading platform itself. Okay. The fees tend to be a lot higher when you're new to trading or when you're learning how to trade. Using the market feature you should give yourself a while. Okay. If you're practicing technical analysis and if you're practicing how to trade, I would advise that you stay away from the market sells and market buys just for the short term. Just for the short term. As you get more fluent, as you get more confident in your ability to utilize these applications and these sort of these little subjects, you'll be able to do it on your own accord, and you'll be able to sort of be responsible for yourself as well. Okay. So in this particular instance, we're going to use pending. Okay. Now, the next question is, okay, below that, what do I see here? Units. And it says available 0.04. Now, this is where it gets interesting. This is where the question that you guys always ask me about leverage comes into play. Okay? Now, let's say, for instance, you have an account that is, what's the account size here? What's the account size? This demo account is £4,848. That's the size of the overall account. So the question people tend to ask is, well, how much leverage should I use, bro? And should I go all in? Okay. Sometimes people don't know if they should go all in or not. So what they do is maybe they'll lower their position size and they still won't have any stop losses. They still won't have any sort of invalidation levels. Now, in our instance, we know that our stop loss is going to be 25,200. Now, on this application, it comes out as 25,153. However, we're going to stick to what we see on our charts. We're going to use 25,200. So the question I have now is, let's zoom into this a little bit here. If we know our stop loss is going to be above these highs, the question is, what is leverage? Because we know where our invalidation is. We know where our stop is. We know where we're wrong. We know at what price we're going to enter the trade. We can set a limit order. The next question is, well, if I've got all of that, then what's the next step? How do I utilize leverage? Now, leverage, we've got to ask ourselves, what is leveraging? What is leveraging? Leveraging is essentially borrowing money. Okay? So, one of you say to me, hey, NJ, I've got £4,000 here, or I've got £4,800 here. Can I use this as collateral? What I'd like to do is I'd like to use this £4,000 as collateral, but I want to trade £400,000. Now that sounds absurd, right? But that is the beauty of leverage. Okay? That's the beauty of leverage. You can take a small sum and you can turn it into a very, very big sum. Okay? Obviously, liquidations become a thing, but we'll talk about liquidations soon. Right now, we just want to focus on how to get the basics right. So, if leverage is borrowing money, then how does this work? Now, I want to go back here very quickly and show you this one more time. If you look here, it says available units. So units is how much of a position that you want to take within the trade. And available is how much you can actually take. Okay? So before I configure the leverage, let's just have a quick look. If I go to stop loss here and I type in 25,200. 25,200. Okay. What he says here is that if I get stopped out at 25,200, I'm going to lose £12.96 based on 0.01 units. Does everybody understand that? That may have gotten a bit tricky. So we've got units, we've got the available units based on the amount of money that we have in the account. It says 0.01 here. That's the lowest amount of units that you can purchase to buy or to sell. Okay. And if you get stopped out at 25,200, which is where we agreed that we were going to put our stop loss or our invalidation level, we lose £12.77 or £12.96 or whatever it says. Okay. Now, I can move this up. So if I move this to 0.02 in the units, okay, I'm now trading with a bigger size. We'll talk about margin in just a moment. Okay. I can trade with a bigger size. And also, if I get stopped out, I'll now lose £25 as opposed to the £17, the £12 I was going to lose earlier. Okay. Again, if I'm to increase again the units to 0.03, again, it's the same thing. I see that my stop loss at 25,200, if I am to get stopped out, I'll lose £38.50. And the more that we increase our size, the more the stop loss gets wider and wider. Okay. Now, you'll notice something a bit silly here where I've increased it to 0.04 and suddenly the application is asking me to deposit funds. Why is that the case? The reason for that is because of the keyword margin. Now, I know a lot of you guys have heard the word margin. I know a lot of you guys don't know what margin is. Okay. So, how do you explain margin in a way that the simple man can understand, the simple woman can understand? Margin is essentially how much you have. Okay. So let's say, for instance, you have an account size of £4,848, like I do right there. Okay. That's my margin, £4,848. Now, according to what this application is saying, for me to sell 0.01 units of Bitcoin, I need to have £980 in my account. That's fine because we know we have £4,800. If I want to sell 0.02 units of Bitcoin, I need £1,960 of margin in my account. That means my account needs to have a minimum of £1,960 in order for me to sell 0.02 units. If I go to 0.3, it says the same thing. I now need £2,940 in order to sell 0.03 units of Bitcoin. So now you can understand that the margin is how much you have as your overall balance. But let's say, for instance, this doesn't work for you. Say, for instance, you've got £5,000 in this account and you want to trade with a bigger size. How do you do it? How do you do it? That's when leverage gets involved. That's when borrowing gets involved. That's when you have to start looking at leverage and how it can benefit you. Okay? Because we know that the number of units is your position size. Okay? Now, position size, let's say, for instance, I put 1 here. Okay? We've been using 0.01, 0.02, 0.03. You know that your favorite traders use 5 to 10 lots. Okay? Your favorite traders will use 5. Your favorite traders will use 10. Okay? So if we put 1 here and we go to the stop loss and we put 25,200, it says that if I get stopped out, I'm going to lose £1,280. All right. But that doesn't work because it says that the required margin is $98,000, £98,000. Now, I haven't got £98,000 in my account. I've only got £4,800 in my account. So how do I make that work? I need to borrow money in order to allow this application to let me trade 1 lot. Make sense? I hope it's making sense. Rewatch this video if it doesn't, because after a few times it will make sense, okay? We're going to talk about a lot more in a moment too. I know I'm going around in a bit of circles, but that's why I wanted to come live, so I could explain it in my own way as opposed to a recorded video where you're... So, what is stop loss? Stop loss, yeah? Let me explain stop loss. Invalidation. I wanted to do it this way because it's more organic. You can see what I'm doing. You can see how I'm doing it. Even if you're not watching this live, you know I'm with you right now. You get me? I'm like your friend or something. So the next question is, all right, if I need to borrow money to make my margin appear bigger than it actually is, how do I do it? Well, this is where your favorite part of the subject comes up, and that is leverage. Okay. So if I go to my accounts, which is here, and I click on manage accounts. Now, this is just simple effects. On every sort of platform, it will be different. It will be different on Bybit. It will be different on Delta. It will be different on Prime. It will be different on I don't know, goodness, MXC. It'll be different on Binance. It will be different on Gate. It'll be different on everything. On Simple FX, this is how it is. But once you do it on one platform, you'll kind of figure out how to do it on other platforms as well. So over here, I can see here is my account size, £4,848. And I can see leverage is 2-1, which means that I can borrow up to 2 times the amount of my £4,800. And that is why I'm allowed to trade with a maximum size of 0.04 units. Okay? Rewind the video if you didn't quite understand what I just said there. It will make sense if you watch this a couple of times. So I decide to myself, okay, I know I need roughly around £90,000 in order to trade this. So I've got around £5,000. Let's see if 25x leverage will work. I'll tell you what, we'll go to 33 just to be safe. Okay. We'll go to 33. You'll get a notification here that says, please note that as leverage increases, small price changes in underlying assets are magnified and that the amount of margin required is likely to be affected accordingly. By clicking change leverage below, you acknowledge that you have read and understood the risk disclosure statement. Okay? The reason this will come up is because it will tell you that if you're borrowing money, if you're trying to inflate your margin and make your margin appear bigger than it is, you have more chance of losing a hell of a lot more money. And I'll show you that right now. Okay? So, okay, change leverage. Our leverage has now changed from 2 to 33. Okay? So let's go back to our chart here now and let's go back to the new order. Suddenly, look what's happened here. Our available units has now changed to 0.8, whereas before it said 0.04. So when it was at 2-1 leverage or 2x, our position size capped us to 0.04. And now coming back to it after changing our leverage to 33x, it's come back to say our position size is 0.80 or 0.79. Now let's do another example of that just for the sake of argument. So if I go to manage accounts, here's my account here, £4,848. Let's go to our favorite number, which everybody loves to use, 100x leverage, confirm. Risk disclosure, okay, change. There we go. Now we're at 100x leverage. If I click on new order, what's my available balance? What's my available units? 2.42. Fantastic. Now I can trade with size. This is the way people look at it. Now I can trade with loads of size. If I go all in, okay, and I go to take profit, the price is 23,600 right now. If it goes to 22,000, I'm going to make 3,300. I could potentially double my account. This is going to be amazing. Let's do it. However, what was the first thing that I taught you in this video? The first thing that I taught you was you need to have your invalidation level. You need to have your stop loss. So let's not be greedy. Let's not be cheeky. Let's put our stop loss in as well. If we get stopped out at 25,200, we will lose £3,000. Now, if we lose £3,000 and our overall account is £4,848, we're not risking 10% anymore. We're not risking 20%. We're risking 70% of the account. Now, say for instance, a scenario like this unfolds, where price stopped you out at 25,200, you have over leveraged your position, you've gone all in, as most people do, and what's happened is you did set a stop loss, so good for you. You didn't get liquidated. You set a stop loss. Fantastic. But you've blown 70% of your account. And this is the trap. This is where people fall into the trap. Okay? So this is the trick. This is the trick. And I want to show you guys the trick right now. This is the alpha. Okay? Now, I'm going to take it a step further and I'm going to put 1000x leverage. What am I doing? This is insane. This is crazy, right? 1000x leverage. If I go to my stop loss here now, I do this. Now, this doesn't quite make sense, does it? What I've done here is I've upped the leverage to 1000x. I've gone onto our trade, okay? I've gone to a trade and I've clicked on the available units, which has now gone from the initial 0.04 at 2x leverage, and it now says 9.69. But you know what? Let's be realistic. We know that a lot of people are going to see this number and think, wow, using my £4,000, I can now trade like one of the bigger boys. I can now, if I get this trade right, okay, if I get this trade right and it goes to 22,000, I'm going to make £13,300. That's 3x my account. You know? That's the enticing. That's where your brain starts messing with you. That's where the emotions start messing with you and you start thinking, wow. But let's see what happens now if I get stopped out. If I get stopped out, I lose £13,000, £12,300. But that doesn't make any sense because my overall account size is £4,800, which means that is the maximum I can go to. Now, if we start playing around with this stop loss, we can see where we'll get liquidated. So let's say, for instance, we put 25,000. Okay, at $25,000 for a stop loss, it says I'll lose 10 grand. So we know that we'll get liquidated way before that. If I put $24,000, it says that I'll lose 2,600. So $24,000 is around here. We know that's not far away from the current price. Let's increase it a little bit to see where we'll get liquidated. Let's say maybe 24,300 and it says £5,000. So somewhere between 24,200, yeah. So around 22,250 is where we get liquidated. So I want you guys to pay attention to what I'm saying here, because our invalidation level, which we decided at the beginning of this video for this fake trade that we've taken, is $25,200. That is where I'm wrong on the trade. That is where I think that if price goes to that level, we're going to be wrong on the idea. We want to exit the position. We're happy to take the loss that we've defined. We'll go back to the drawing board. Okay? Now, in this particular instance, I've increased the leverage to 1,000. And it's saying here that I can't even put a stop loss of 25,200. It doesn't even let me do that. It says, according to this, that at 24,250, which is almost $1,000 away from my stop loss, I'll get liquidated. And liquidated means that your margin goes to zero. And if your margin goes to zero, you already know now from watching this video that margin is how much bread you have in the bread bin, how much money you have in the account. In this particular instance, as you can see here, my margin or my overall account size is £4,848.29. And according to this, at 24,250, which is $1,000 away from my stop loss, I will get liquidated. Now, okay, so many people who claim to be great traders, they say that leverage is irrelevant. Leverage doesn't matter. So how do I use 1,000x leverage and how do I use it safely? Okay, that's a fantastic question. Now, do you remember earlier on in this video, rewind it if you haven't already, when I first started showing you this example, I showed you this example with the leverage set at 2x. When the leverage was set at 2 to 1, the available units was 0.04. That was the maximum that I could trade. Okay? Now, initially, if you rewind the video, to trade 0.01 units at 2x leverage, it would utilize £1,000 of my margin, or £980. Let's have a look now to see if it's different with 1,000x leverage. Interesting. So using 2x leverage, when trying to trade 0.01 units of Bitcoin, it would have costed me £980 of my margin. Okay? If margin is the amount that you have, if you're putting some of that margin into a trade, let's say for instance, I decide to sell 0.01 units of Bitcoin at 2x leverage, it would mean that £980, or let's say £1,000 for sake of argument, of my margin will be utilized within that trade. Okay? It means that I've got roughly around £3,800 left to go into other trades. However, in this particular instance, it means that I'll be using 20% of my margin. Now, when we increase the leverage to 1000x, according to this, it says that to sell 1 unit of Bitcoin, 0.01 units of Bitcoin, it will only cost me £4.89. Okay? Are you guys with me? I've increased the leverage by 1,000, which means that I'm allowed to borrow more money from the exchange. I'm allowed to use more from the exchange, and my margin will be collateral. And the reason for that, the reason for this is because at 1000x leverage, I'm trading with an account size that is 1,000 times, somewhere around 1,000 times this number. Okay? That is the spoofed margin, the fake margin. I hope you guys understand that. All right. Now, how do you make this work in your favor? How do you make this work in your favor? So let's go back to our original example, which we set around 30 minutes ago, where we said we want to risk 10% of the account. We don't want to risk any more than that. On an account that's £4,848, I wouldn't advise you risk 10%. I would advise you risk no more than 3-4%. But we're going to use our example. We're going to risk 10%, and we only want to risk 10%. Now, at 1000x leverage, at 500x leverage, at 100x leverage, at 3 million leverage, it doesn't matter what the leverage is. What matters is, number one, your invalidation, which we have decided is 25,200. Now, at 0.01 units, we know that we'll only lose £13. Okay, but we want to risk 10% of the account. Now, 10% of the account in this particular instance will be £485. So I start playing around with the numbers now, okay? I can see here that to sell 0.01 units is £4.89. Now I'll start playing around. So let's see. I want this to say £485. I'm willing to lose 10% of my account if I get stopped out. No more, no less. Let's have a look. So I'm playing around with the units. I'm playing around with the units. There we go. There we go. So look, this is just a bit more than 10. Maybe I'll lower it. Maybe I'll lower it to that. So now all I've done is I've increased the units. I've just clicked the plus arrow until I've increased the units. And it says, okay, you want to take this trade. This is how many units you have available because you're at 1000x leverage, 9.71. You've decided today that you want to take a trade of 0.36. The margin that you're going to need is £176. Okay, so the moment you take this trade, it's going to be, this is what's going to be used within your margin. All right, you'll have the rest of it left. This is your take profit, and this is your stop loss. If you get stopped out, you will lose roughly around £465. Now, this is the part where you guys have to keep rewatching it over and over and over again, because this position sizing is so important. What a lot of people tend to do is they'll crank the leverage as much as possible and they'll go all in. All right. Or I've done this before. I did this in 2017 where my account size is £4,800. So what I'll do is I'll increase the leverage like this. Not leverage. I'll increase the position size like this. Okay. So what I'll do is I'll increase the position size like this, right? So that I can still get stopped out at 25,200, but I lose my whole account. And I've done it so many times when I was in 2017. So many times I did that in 2017. And I know that a lot of people in the current market, they do that as well. You know, this is not as bad as this is nowhere near as bad as going all in with no stop loss. Even this is a step forward in order to sort of get better at trading, but this is still the wrong way of doing it. Because when you have an account size like this, your objective, your mission is to preserve your capital. So it goes back to what I was saying again. If 3.5 is going to lose me my whole account at my stop loss, which I've defined with you, what do we need to do? We need to risk 10% of our account. Or if you're taking risk management seriously, 1% of your mother 1% of your account. Okay? Now, I know a lot of you guys have stories. I know a lot of you guys have difficulties. The first step in understanding leverage is being able to protect yourself. Really and truly. Leverage will give you a rush. It will give you such an adrenaline rush. You know? It will make you feel like you're on top of the world, especially when it goes right. Think about it logically. All right. If we crank up the leverage, if we go all in at 3.5, if our target hits at 22,000, we're going to double our account. Look at the profit. Look at the take profit. TP, it says we'll make £4,700. Now, if I show you that on the chart, where is 22,000? There is 22,000 right there. Just where my cursor is. That could happen in one candle. And if that happens in one candle and you've risked the amount that you've risked, you've gone all in, all right, with a stop loss just above these highs, if it does get to 22,000, you're going to be feeling euphoric. It is one of the most sensational feelings I've ever felt in my entire life. And you know what? It's addictive. But what is the problem with what I'm saying right now? The problem with what I'm saying right now is that when you're playing this game, you can't have emotions. And once again, I want to bring it back to real life examples. When you put your shirt on in the morning, or when you're putting your makeup on in the morning, okay? Why are you doing that? You're doing that because there's a dress code at work and you have to adhere to that. When you go to work in the morning, when you're on the train, when you're on the bus, when you're driving, you get to work. Do you get to work on time or do you get to work late? No, you get to work on time. Why? Because that's a rule. If you don't get to work on time, you're going to get in trouble. Perhaps you'll get a strike. Perhaps you'll get a demerit. Perhaps you'll get a verbal warning. Whatever it is, you get to work on time. When you're speaking to your colleagues, you speak with respect. You speak with professionalism. There is a certain level of etiquette within the workplace. Okay? That is no different to trading. In trading, you have rules. Risk management is one subject. And believe me, this is the tip of the iceberg. This is just to get you guys going. It goes way deeper than this. If somebody like XO sits in this seat and starts talking, goodness gracious, ooh la la. You know? If you have a stop loss and you've defined your stop loss, well done. If you have an invalidation that goes with your stop loss that says, look, I'm not just plotting a stop loss for the sake of plotting a stop loss. I'm putting my stop loss here because that's where I'm wrong. That's where I'm wrong. For example, I'm using hindsight because hindsight is what we have to use. Look at this here. We've got a consolidation area here. Price goes all the way down. You've missed the short. Price comes all the way back up here. You've decided to take a short right here. Where's your invalidation going to be? Your invalidation is going to be above this here. And the reason it's going to be above this here is because this is the up move that led to the market pushing down. So this is the powerful move right here. Now, what happens once let's say for instance, price breaks down and it didn't hit your TP. Your TP might have been somewhere down here. What happens when we get stopped out? Let's follow it, all right? Let's follow it. We get stopped out here, and what does price do? Price starts ascending higher. And that's the reason I say that if you're wrong, if you found your invalidation level, it's when it defers your bias. So for instance, if my stop loss was here and price breaks above it, my argument is that we're going to start pushing towards the upside. Okay. And price, funnily enough, does that. Price taps me out right here, it pulls back, and then it starts making higher lows and higher highs. Okay. So once you've got your stop loss, the next thing that you need to focus on is position sizing. If you've only got an account that's very, very small, you need to crank up the leverage, because you might not just want to be in a Bitcoin trade. We have other pairs as well here. We have Ethereum. Now, if I'm shorting Bitcoin and I want to also short Ethereum, how do I do that? I need to make sure I have enough margin. As we've already said, margin is how much money you have in your account. Now, if I need £200 to short Bitcoin, I'm going to need another £200 to probably short Ethereum as well, wouldn't I? Okay, which means that I need a margin of £400. So let's say for instance, if I go here now, let's go to Bitcoin, okay, open chart, and I say I'm going to sell Bitcoin here, new order, I'm going to sell. I want to risk 10% of I want to risk 5%. I'll tell you what, we're going to risk 3%. So overall today, I want to risk 10%. I'm going to risk 3%. Okay. So 3% is going to be 150 quid, roughly 150 quid. So what we'll do is we'll go to our stop loss, 25,200. And then I want to risk £150, which brings me up to 0.012 in terms of the units. My take profit is going to be, I don't know, somewhere around here, I guess, 22,800. 22,800. Well, that's not very good. That's not one-to-one. Let's say 22,000, just 22,200. Okay, so I lose £150 or I can make £150. Let's click submit. There we go. So as you can see, I've taken this position now. All right. This is where I sold Bitcoin. This is where my stop loss is above this high here. And this is where my take profit is. Now I can fiddle around with this. I'm just putting this here for now. Okay. I can do that. But the most important thing is, you see, let's say for instance, I start falling asleep right now at my desk. Let's say for instance, I'm watching the price, I'm watching the candles, and I decide I'm going to fall asleep here. Okay. I'm protected now. There's no such thing as liquidation. I'm protected. If I get stopped out right here, that's not an issue. Because I know I was willing to risk £150 and I wasn't willing to risk any more than that. Only £150. And if I get stopped out, no matter what part of the day, whether it's a black swan event, whether it's liquid, whether it's, I don't know, maybe Elon Musk tweeted or somebody did something that made Bitcoin push up like crazy, I'm protected with this stop loss. This stop loss is going to only make me lose £100. You know, this type of price action, lower high, lower high, lower high. We haven't broken market structure yet. We really sort of need to break market structure here, really, to start pushing lower. This is just a fake short that I've taken. What's to stop price from doing something like this up move here? Price can do that, and it can stop me out aggressively and come and take these highs out here at 32k. Now, if I've fallen asleep and I haven't set my invalidation, if I haven't set my stop loss, I'm gonna get liquidated. It will use my whole margin as price goes up to that region. If price goes up to that region and I've gone all into the trade, then I won't even get stopped out at 25,200. I'll get stopped out way earlier. I'll get stopped out within this candle alone because I've gone all in. When you're thinking of margin, you've got to think of capital preservation. That is the trick. That's the trick. Capital preservation. Now, of course, I can talk to you guys about R. I could talk to you about risk to reward. I'm going to talk about risk to reward, but I'm not going to really focus on compounding today. I want you guys just to understand the absolute basics, and I want you to understand how to trade these basics. I can see questions coming into the chat and stuff like that. I can see some people asking stuff, but please just stay focused on risk management today. Any sort of specific questions you have about anything else, ask me on tomorrow's live stream. I wanted to do this for you guys today because you guys helped me got to 3,000 subs. I got to 3,000 subs yesterday. So if you're watching this in the future and I'm at 2 million subs, then that's where we were. you know. So I wanted to do this for you guys, right? You guys need to really understand, okay? And share it with your friends who don't really understand how to trade and stuff, because this is kind of where it gets really, really messy, okay? And we've got somebody in the chat who says it here. Good risk management can make a 40% win rate pretty profitable. And we're going to go into that in just a moment. We've spoken about leverage, we've spoken about margin, and we've spoken about how to size your trade. We said that leverage is essentially borrowing money. We said that margin is how much money you have. All right? We've spoken about position sizes. We've spoken about stop losses, why stop losses and invalidation levels are important, and how to calculate your stop loss. Okay? Now, I've shown you the easiest way to do it. There are other ways to calculate your stop loss. But now that you know how to calculate your stop loss, now you know how to calculate your positions, okay? You should be able to trade comfortably without feeling the fear of losing your entire balance. So let's see, what's the next thing that we're going to talk about here? So let's talk about risk to reward. So if we go back here, okay, we're going to go back to our previous example where we're risking, we have $1,000. Now you guys are smart now. Whoever's watching this, I know that you're super smart now. You understand what this is now. You understand that this number that we've got here, this figure, that's my margin. Because we already know that, simply put, margin is essentially how much money you have in the bank. Now we know that what we're risking is $100. That's 10% of our entire account. You can opt to risk 1%, you can opt to risk 2%, 3%, 4%. Some of the best traders I know risk 0.5% because they know it's not about how much money you make. It's about how much money you're willing to risk. It's about how much money you're willing to lose. That's what trading is. You know, when Rocky says it's not about how hard you can hit, it's about how hard you can get hit. It's the same in trading. It's not about how hard you can hit. It's not about how much money you can make. It's about how much you're willing to lose. And it doesn't matter how many times someone watches this video, and it doesn't matter how many times somebody listens to me saying that. I overheard it over and over again, and it didn't really click for me. It took ages for me to really discipline myself, establish my emotions, and say, hey, it's not about just being right on the trade. If I get stopped out, I only want to lose the percentage of my account that I've said I'm going to lose. Once you get to that stage where you can trade and you can define how much you're willing to lose, and no matter what happens, you won't lose any more than that. That's when you start losing your emotions. That's when your trading starts taking a different turn. That's when you start thinking like a bit of a warrior in this game, you know, because it's not about being right. Who cares about the freaking clout? It's about making sure that you're protected, living to fight another day. So let's take this example now, okay? So what I've done here, for those of you who don't know, as I said earlier on in the video, on TradingView, you have a bunch of tools and stuff here. I've gone to this one here, this area here. I click on this. Long position, short position. We have the rest of the stuff here. I've clicked on short position. And when I clicked on short position, this is what came up. Now, assumably, I've taken the short here at 24,200. My stop loss is 25,200. What's my target? Oh, for flip's sake. What's my target? Is my target going to be here? Is my target going to be here? Is my target going to be here? Where is my target? It just really doesn't matter. Your target is going to be based on your technical analysis. Your target is going to be based on wherever you think the trade is going to go. After all, you're the one who set the trade. You're the one who said, I'm wrong above here. Therefore, you have an idea of where price is going. So for sake of argument, we're going to target this area here. Okay, and I want to zoom in further so you guys can see. Now I've decided I'm going to target this area here. This little swing low that we've got here. I think that price from this level here is going to break down and it's going to take out this swing low before it takes out my stop loss, which is here. So price is now going lower. Price is going lower. We know how much money we're going to make because if we go to the trading application that you use, if we go to the order, as you can see here, look, I've got my order running. Let me remove my camera for a second so you can see. And you can see, here's my trade. My margin, my equity, my overall margin, which is my equity, it was £4,848, but now because I'm down £20, it says that my equity is now 4827. My free margin has changed to 4769 because I've used some of that margin to take this trade. I've sold 0.12 units. Okay? Now, if I want to take a new order, excuse me, sorry, I click here and I click on new order. Now, I want to take another short perhaps. I already know what to do here. I already know when I set my take profit, it will tell me how much I'll make based off 0.01 unit, which is the lowest that you can put. I know that if I take my stop loss and I put my invalidation level, it will tell me how much I'm losing based on the unit. So that's fine. We know how to decipher that. We're not scared of that anymore. Okay? We already know what to do there. The next thing that we have to do is we have to say to ourselves, all right, well, if I'm going to risk $100 in this area here, so if I'm going to risk $100 here, if price comes above this level, I've lost $100, which means my account will be $900. Okay? How much am I going to make if it comes here? And is it worth my time? Is it worth taking the trade? If I'm risking $100, right? Have you ever heard the saying, an eye for an eye? You don't ever hear the saying, an eye for a fingernail, or an eye for a toe, or an eye for a nipple or something. I don't know. I'm just making it up as I go along. It's always an eye for an eye. Okay? So in this particular instance, if we're risking $100 from here, then surely if we're going to win the trade, we shouldn't win any less than 100. Okay? So again, if we're risking 100, that means that 1R, R stands for risk and R also stands for reward. You have your risk in the red and you have the reward in the green. Okay? So let's do some more. Okay. So when somebody says, how much R did you make? Or how much R are you risking? Or whatever. Now you know what to say. If somebody says, how much is 1R for you? You can turn around and say, hey, my account size is $1,000. That's my margin. That's what I'm willing to play with. That's how much I have in the account. 1R is $100 for me because I'm risking 10%. Now, if 1R is 10% and 1R is $100, then by default, I need to make sure that I'm at least making 1R back when I'm trading. So I look at it like this. Let's say, for instance, the price here is 24,200. That's where I took the trade. It's $1,000 to my stop loss, which is 25,200, which means that if price goes from 24,200 to 25,200, 1,000 pip or 1,000 point or $1,000 increase, I'm going to get stopped out, which means that it needs to go down by $1,000 in order for me to make 1R. If it goes down by $2,000, that means I've made 2R. If it goes down by $3,000, it means that I've made 3R. Understand? Now, in this particular instance, I took the trade at 24,200. My target is 22,398, which is just this is a very random trade. Please do not take this trade if you're currently watching this live. Okay? Now, how do I discover what my R is? So what I do is I can hover. TradingView is a very beautiful platform, by the way. I love TradingView. It's where I live, on TradingView. Most traders live on TradingView. So if you've got TradingView, fantastic. If you're not using it, get involved. All right. Maybe you're watching this a couple of years in the future. Maybe we have something else now. I don't know. But today, the 17th of August 2022, TradingView is the best by far, by far. All right. Now, if I hover my mouse over this short and long box that I've got here, it tells me here, it says, well, this should say $1,000. Okay, 1 second. So style, visibility, short position input. So risk is 25. Okay, so entry price is 2,200 and stop level is 200. Now, again, we look at this trade again now, and it says over here at the top, if you can see it, just right at the top of the red box, it says 1,000. That is how many dollars it will take for my stop loss to hit. Next to the 1,000, it says 4.13%. So Bitcoin would have to increase from my entry by 4.13% for me to get stopped out. Okay? Now, similarly, below that, where the green is right here, where my mouse is hovering, it says 582.9. That's how much Bitcoin has dumped since we apparently took the short. Bitcoin has dumped 0.25%. And if Bitcoin hits my target, I'm going to make 1.81R. It will take $1,807 down here to get to my target. And if Bitcoin moves by 7.47%, which is here, that's how much of a move required in order for Bitcoin to hit my target. Which means that this trade I've taken here, if it hits target, it's a total of 1.81R. Now, let's say, for instance, the trade starts reversing. I've decided that I'm no longer comfortable with this trade. I've seen something that really, really bothers me. I want to exit the trade right now. How much money do I make? So if I use this green box here and I drag it up to here, okay? If I decide I want to cut the trade here, it will say that I've made 0.65R, which means it's 0.65% is 0.65%, 65% of $100. So 0.65R in this example that we've used here is $65. If I decide I want to cut the trade here, I go to Simple Effects. I've decided something is wrong. I want to cut the trade. Over here, I'm £7 down because I took the trade live and I took it earlier on. But over here, we took it earlier. I say, I want to cut the trade. I'm scared. I click the X button. The trade has been closed. The damage has been done. Or maybe you've won whatever you've won. You're out the trade. Now, the next question that we have is, let's say, for instance, you've got your stop loss. You've got your long position or your short position. You understand what 1R is. You understand that when you're taking a trade, it should be at least, as a very minimum, a 1-to-1 ratio. How do you make that profitable? What happens if you're trading? What happens if I take 10 of these? I'm risking $100 per trade and I get stopped out 10 times. I've lost 10 times. Okay, maybe I haven't lost 10 times. Maybe I take 10 trades and I get stopped out 7 times. And I win 3 times. What's the rule of thumb? You know? The rule of thumb when trading, in order to be profitable, is that you should always be looking for 2 to 3R per trade. 1R trades are very good. They are very, very good. And as your balance increases, as your size increases, it will become more plausible for you to trade for 1R. I understand. However, when trading early on, you want to look for a minimum of 2 to 3R. So for instance, in this case, I go back to my short position. I come here. I click on here. I know my stop loss is going to be here. I'm looking for, there it is. It automatically did it itself. So 2.98. 2.98. That's my risk to reward. I want to see price drop here. Now, let's say, for instance, price does that. Let's say, for instance, price does this and it drops, it hits my target. We are now up 3R. Okay? Which means that we've made £300 or $300 because we were risking $100. Okay? We didn't get stopped out. Price dumped, it hit our target. We've made 3R. Now your account balance is $1,300. You've increased your account size by 30%. Okay? So now suddenly, you now have $1,300. Now the question is, now that you've got $1,300, are you going to change your rules where you only risk 10%, or are you going to be disciplined enough to stick to it? If the rule is we only risk 10%, then even if our account has grown by 30%, we still have to make sure that we're only risking 10% overall. So even that 30% that you made on this account, you still got to make sure you're only risking what you defined as your risk. And also, if every trade that you take based on your strategy, based on your technical analysis, if every trade that you take has a minimum of 3R, that means every time you win 3R, it's as though you have prevented yourself from getting stopped out 3 times. It's as though you've given yourself 3 cushions. Do you understand? Which means that if I take this trade and it goes to target and I now have $1,300 instead of $1,000, I can get stopped out 2 times now and I'll still have more than I started with. If I get stopped out and I lose $130, I'll have 1,170 left. If I get stopped out a second time, I'll have $1,040 left. My account has still grown. Now, you can be wrong when you're looking for trades that are 2 to 3R. You can be wrong 2-3 times, and one trade will not only make it all back, but one trade will make you profitable. Something that you guys need to think about. This is a video that you're going to want to watch a few times, and I don't want to drag it out too much because for people who are watching it in the future, they may not have 2-3 hours to watch this. So we've spoken today about stop losses and invalidations. We've spoken today about leveraging and what leveraging actually is, how to actually use leverage. Leveraging isn't about how much leverage you can use. It's not about using 1,000x leverage or 2,000x leverage or 3. It's not about that. Leveraging is just designed to make sure that you can increase your position size or decrease your position size or use your position size in a way which doesn't utilize your margin. And if you're not utilizing your margin too much, you can take multiple trades. You can be in multiple positions at once. Maybe you don't just want to be in one position. Maybe you want to be in 4 positions. Something to think about. Something to really, really think about. Okay? We've also spoken about R. What is risk and what is reward? How many R are you? What is your 1R risk? What is your risk for 1R? Well, my risk for 1R is $130. How much R are you looking to make off this trade? I'm looking to make 3R, maybe 5R, maybe 6R, maybe 10R. I don't know. That's how much, but minimum 1R. Minimum 1R. You should never be taking a trade where you're risking 1R and you're only looking to make 0.5R. Because whether you win or you lose, you've risked double what you were willing to make. Okay? Now, the same applies in reverse. If, for example, price starts doing something like this, and as soon as it sort of gets above this level and holds here, I decide I want to cut the trade maybe I either want to change this to break even, I'll cut the trade at break even, or maybe price starts pushing up and I'm not liking that. Maybe we get a close. Maybe we get a close around this area here on the daily, and I'm not happy with that. I'm thinking to myself, I want to cut the trade. The same thing applies. The same thing applies. At this level up here, that's where I get stopped out and I lose 1R. But anything in between, I'm losing less than 1R. Maybe when price starts doing something like this, I cut the trade for half an R. And if 1R is $130, half an R will be $65. Okay, which means that I've only lost $65, which means that I've only lost half an R. It's you shouldn't really be losing more than 2R a week. If you're taking trades like this and you're losing 2-3R a week, you're doing something really, really wrong. And that brings me to the final sort of subject, the final sort of topic point that I want to bring up on this, which is how to utilize this risk management strategy, not just to become profitable, but to help discipline how you trade. And the final thing that I'd like to speak about in terms of this is how to manage your drawdown. Okay? Managing your drawdown is just as important. Now, I've mentioned here, right, that if price was to do something like this and maybe get a close into these wicks, I'd be looking to cut the position. So maybe I'm down half an R. So the best way I like to do it is you set yourself a target. Not how much R you're going to make, because we know that Rocky says it's not about how hard you can hit, it's about how hard you can get hit. So we know it's not about how much money we're making, how much R we're making. We don't have a target for that. We're not going to say we want to make 10R a week, 20R a week, 30R a week. We're not going to think like that. We're going to think in a way that tells us, I don't want to lose more than 3R in a week. If I lose more than 3R in a week, it means that I'm not really in sync with the market. It means that I'm not performing to the best of my ability. It means that I'm letting myself down in terms of trading. So if we're only going to risk 3R a week, then essentially you can only get up to 3 trades wrong in the week. If you get 3 trades wrong and your risk is 10%, your risk is $130. That's not very good, because if you get stopped out 3 times in a week, you've lost 30% of your account, my friend. That's why most traders like to do 0.5% or 1%, 2%, 3%. I understand that when you have $1,000 account, you want to do 10%. I get it. You're all looking for that one big trade where you smack out 20, 30R, and then finally you're in the game. That's when you can apparently lower your risk. You know, I get it. I really, really do. So when you're giving yourself a target of how much you can lose in a week, how do you maybe put that into your favor? Because, you know, the last thing that we want is for us to get stopped out and you're having to lower your risk and you're making maybe $20-30 on a trade. It just doesn't feel very good. I understand it doesn't feel very good. It feels mind-bogglingly boring. What do? So for me, I mean, I don't use this particular example, but I'm just giving you an example. Let's say, for instance, you've got 3R which you're willing to lose in a week. Okay? If you lose 3R, you've got to stop trading. If you lose 1R, you've got to make sure that the next trade you take meets every criteria that you want for a trade. If you've been watching the NJ show for a couple of weeks, you guys will know that, I talk about, God, what was I going to say there? When you're watching the NJ show, I talk about managing your positions. I talk about managing how many positions you're in and how many positions you should take, etc., etc. But when you're taking these kind of trades and price is going against you, if you've lost 1R, the next trade, you need to make sure you've got a good 5-6 reasons as to why you're taking that trade. All right? 5-6 good reasons. Why are you taking this trade? And if it doesn't go to plan, you've now lost 2 trades in that week. You've got to do something to lower your risk. Maybe what we'll do is, if we've only got 1R left for the week, what we can do is, if we want to trade every day, we can split that 1R up into 3 more trades. So now, for instance, if I want to take a trade like this and I've already got 2 trades wrong from Monday, right? I can do $130 divided by 3, and that is my new 1R. That gives me 3 new chances to trade until, of course, I make that money back. Anyway, I will leave it with you there. I'm sure that you guys have a lot to think about. I'm sure that you guys have a lot to focus on. Please rewatch this video as many times as needed. Okay, it's not an easy subject. This is the tip of the iceberg. There is a lot and a lot to talk about on this subject, but I get confused when people talk about how much leverage do you use and how much this do you use and what's this and what's that. People just don't understand the tools that are in front of them. They have the right mentalities, but they just don't understand the tools that's in front of them, and they don't understand what the right questions to ask are. They think that they're asking the right questions at the time, but they're not. So watch this video as many times as you need to. Feel free to drop me a comment if you have any questions that don't make sense. Maybe in the future we'll do an updated one. Maybe in the future we'll talk about more things like how to do compound trades, evolving R. Maybe we'll talk about how to why traders put their stops at break even. But for now, for today, I want you to just focus on the absolute basics. Prove it to yourself, whoever you are, not just the people on the live stream, but whoever you are watching this back. Prove it to yourself. Say that I know what an invalidation is. Say that I know what a stop loss is. I know how to use it. Say that I know what leverage is. I'm not going to ask a question like what leverage do you use? I know what leverage is. Leverage means X, Y, and Z. This is how to use it. Maybe I don't have much money in my account. I need leverage in order to create a larger size that's worth me trading with. I can still risk whatever I chose to risk. And this is why you see many traders on Twitter, on Telegram that say it's not about leveraging, it's about your position size. So please watch this video again. Look at the examples I used on the Simple FX application. It will be the same for every other trading application that you use. All right? Anyway, guys, I hope you guys are all doing well. I apologize for not sort of blasting the comments today. This is a video that's for the future. A video that you can always come back and watch, a video for people that are joining the channel now. I know some of you are OGs and some of you have been watching from day one. I thank all of you. And if you're new to the channel and if you're enjoying the content, please do make sure you like and subscribe. Like the video, subscribe to the channel if you're learning something new. And we'll catch you on the next one. Okay? Take care. Goodbye. And thank you for 3,000 subscribers. I really, really, really appreciate it. Let's get to 4,000. All right. Share the video with your friends. Share the channel with your friends and your family. Let's get to 4,000 subs now. All right. Cheers.